In an opinion piece by BNN Bloomberg, CPP Investments CEO John Graham said he sees potential value in large-scale domestic infrastructure projects proposed by Prime Minister Mark Carney. His comments come as the $714.7 billion fund considers reversing a decades-long strategy of international diversification to increase its stake in Canada. We think that there may be the will to actually build some of these things, Graham told the Canadian press, referring to infrastructure like bridges and pipelines that could benefit millions of Canadians, contributing to the public pension. New focus on Canadian infrastructure. The remarks reflect a broader effort to reduce Canada's economic dependence on the United States, stimulate the domestic economy, and strengthen ties with global markets. The Canada Pension Plan Investment Board, CPPIB, which manages the fund, may now explore opportunities to invest more within the country. The shift would mark a notable departure from CPPIB's long-standing diversification strategy. As of March 31, 47% of its holdings were invested in the US, compared to 12% in Canada. The remainder included 19% in Europe, 17% in the Asia-Pacific, and 5% in Latin America. The portfolio is also diversified across asset classes and sectors. Canadian public equities account for less than 3% of global markets, and most of that exposure is concentrated in the resource and finance sectors. Historically, CPPIB avoided concentrating its risk by investing heavily outside Canada. Performance and Global Ranking CPP Investments reported a net return of 9.3% for its latest fiscal year, slightly below its benchmark of 10.9%. The strongest gains came from public equities in the US and China. Despite tensions over global trade, a weaker Canadian dollar also boosted returns by inflating the value of foreign investments when converted back to CAD. Global SWF, a state-run tracker, ranked CPP Investments second out of 25 global pension funds for 10-year returns from 2015 to 2024. The fund posted an average annual return of 9.2%, just behind Sweden's AP7, according to a 2012 report from the Office of the Chief Actuary. Of Canada, the CPP fund requires only a 4% real rate of return per year until 2087 to remain sustainable at current contribution rates.